to go straight into the keynote speech, and this will be given to us by the Governor, Central Bank of Nigeria, Godwin Emefiele, who happened to be the former Group Managing Director slash CEO at Zenith Bank PLC. He also happened to be the former Deputy Managing Director, Zenith Bank PLC, and also the former Director of Action Microfinance Bank Limited. He will be ably represented by Dr. Kingsley Obiora, the Deputy Governor, Economic Policy Department, Central Bank of Nigeria. You're most welcome, Dr. Kingsley Obiora.
Governor who is unable to join us in person, but he sends his well wishes and best regards. Before I go into the subject matter at hand, I would like to take this opportunity to commend Nancy and the leadership of the African Economic Congress for showcasing the efforts of both fiscal and monetary authorities to help us stabilize our economies following the yet unfolding impacts of COVID-19 on our lives, on our livelihoods, and on our ways of life. Indeed, the timing of this event could not have been better, especially given the fact that the pandemic is still here with us. That is why my remarks this morning will be centered around the theme, African Central Banks Countering COVID-19. I hope to share our perspectives on the impact of COVID-19 in Nigeria, as well as the measures we have taken to stabilize our economy and stimulate growth for shared prosperity. Prior to the onset of COVID-19 in Nigeria, our economy had been on a positive growth trajectory. We had witnessed 12 consecutive quarters of economic expansion in the aftermath of the 2016-17 recession. More impressively, this growth came along with significant foreign capital inflows due to improved fundamentals of the economy. GDP growth for 2019 stood at 2.29%, supported by a relatively resilient growth of 2.55% in the fourth quarter of 2019. This year, however, COVID-19 has caused unprecedented social and economic disruptions across the world. The rapid spread of the disease, coupled with drastic measures taken by monetary and fiscal authorities to stabilize their respective economies, has changed the world as we know it. In Nigeria, its impact was evident through several channels. First, the virus constituted a challenge to public health, given its contagious nature, and measures had to be taken to contain its spread. These included implementation of social distancing measures and restrictions on movement across major cities in the country, while our efforts were being made to upgrade the capacity of our healthcare institutions to respond adequately to increasing caseloads. The impact of these domestic and global containment measures contributed to the contraction of GDP of about 6.1% in the second quarter of 2020. While important from a public health perspective, led to contractions in transportation by about 49%, hospitality services by about 40%, construction by about 32%, and education by about 24%. Conversely, and I might add thankfully, financial services and telecommunications were more resilient, with growths of about 18 and 15% respectively. These sectors were able to leverage digital channels as Nigerians relied on them to communicate, conduct business, and look out for one another. During this period, the agricultural sector also recorded a 1.6% growth, supported by sectoral productivity gains, interventions by the government, and increased demand for local produce. The second challenge we faced was the close to 60% drop in oil prices between January and May 2020. The collapse in oil prices was driven by a significant contraction in oil demand as a result of the lockdown and virus containment measures around the world. Given our significant dependence on crude oil for revenues, for government expenditure, and foreign exchange earnings, the plunge in oil prices resulted in significant revenue shortfall and a drop in reserve accretion at the central bank. The third challenge we faced was in capital flow reversals. Between January and May 2020, investors withdrew about $100 billion from emerging markets portfolio equity, an additional $20 billion from emerging market portfolio bonds. Uncertainty about the evolution of the crisis of the virus and the extent of its impact led to a retreat in investment from emerging markets and a corresponding rise in investment in so-called safe haven assets, such as US Treasury bills and gold. The resulting outflow further heightened pressures on the currency of major emerging market countries, which include Nigeria, and this ultimately resulted in the adjustment of our exchange rate to about 381 earlier this year. A further challenge that we faced was a disruption in global supply chains as countries sought to ensure that they had significant essential materials for their local market relative to their export market. Many countries moved away from multilateralism and responded by fighting for themselves with several measures to protect their own people and economies, regardless of the spillover effects on the rest of the world. According to the World Customs Organization, a total of about 32 countries and territories adopted stringent and immediate export restrictions on critical medical supplies and drugs that were specifically meant to respond to COVID-19. Indeed, as of April 2020, an updated count of total export restrictions by the Global Trade Alert Team at the University of St. Gallen in Switzerland suggests a total of 102 restrictions placed by 75 countries. As a result of these disruptions and restrictions, we saw an uptick in inflation, which rose to about 13.7% in September 2020. This was exacerbated by the increase in VAT, exchange rate adjustment, and seasonal food supply shocks due to the onset of the farming season and other structural bottlenecks. We, however, expect that given all that we're doing at the central bank, that inflation should begin to moderate towards the end of the fourth quarter, along with the phased withdrawal of restrictions imposed as a result of COVID-19. Now, what has been our response to this pandemic? Across the globe, the unprecedented nature of the pandemic and its full impact on economies resulted in the deployment of massive fiscal and monetary stimulus, particularly in advanced economies, in order to stabilize the global economy. In the United States, for example, in addition to the over $3 trillion fiscal stimulus, the Federal Reserve increased its balance sheet by close to $7 trillion through a massive asset purchase program, which also included the purchase of low-grade junk bonds. This monetary stimulus has amounted to about 14% of US GDP. Following suit, the European Central Bank on its part expanded its balance sheet by about $2.3 trillion over the same period. The Bank of England changed its own rules and has since provided almost infinite financing of the country's fiscal deficit in order to respond and stabilize the British economy. In Africa, central banks have had to balance the need for increased spending to support the economy with additional measures to prevent an undue spike in inflation and heightened pressure on exchange rates. African countries who do not have the same luxury and as a result have had to strike a balance between growth-enhancing measures and mitigating exchange rate and inflationary pressures. In Nigeria, faced with this difficult trade-off, the monetary authorities decided to support growth by taking unprecedented measures to prevent our economy from going into a tailspin. Our first objective was to restore stability to the economy by providing assistance to individuals, small, medium, and large businesses that had been severely affected by the pandemic. Some of the measures we took include granting a one-year moratorium on principal repayments for central bank intervention facilities, reducing the monetary policy rate by 200 basis points from 13.5% in March to 11.5% today, granting regulatory forbearance to banks to restructure loans so that borrowers generally had a longer repayment time frame. We reduced the interest rate on CBN intervention loans from 9 to 5%, creating a 100 billion naira intervention fund in loans to pharmaceutical companies and healthcare practitioners, intending to expand and strengthen the capacity of our healthcare institutions. Strengthening the loan-to-deposit ratio policy, which has already resulted in a 21% increase in loans to the private sector. Approving 3 payment bank licenses, which would accelerate the provision of digital financial services by bank and non-bank financial institutions and reduce the need for paper money. Establishing a 150 billion naira targeted credit facility for affected households and small and medium enterprises through the NESA Microfinance Bank. Already, almost 100 billion of these funds have been disbursed to beneficiaries across the country. Creating a research fund, which is designed to support the development of vaccines in Nigeria. And lastly, creating a 1 trillion naira facility in loans to boost manufacturing and production across critical sectors in the country. The impact of these measures helped to prevent an even larger contraction in second quarter GDP, as had been projected by many analysts. We expect that GDP growth for the third quarter may reflect a significant recovery relative to the second quarter, especially with the phased withdrawal of the lockdown, resumption of travel by land and air, improvement in crude oil prices from $19 in April to an average of $44 in October, continued implementation of our interventions in agricultural and manufacturing sectors, a 40% growth in the Nigerian Stock Exchange All-Share Index, along with a significant pickup in economic activities. We believe that these measures have in no small way made our lives much better and saved the economy from the more drastic effects of COVID-19 pandemic. On financial sector stability, we have also implemented measures in the banking system to prevent an economic crisis spilling over into a financial crisis. We protected the interests of depositors by ensuring that banks made adequate capital provisions to cover unexpected losses, that banks were able to restructure loans granted to sectors affected by the pandemic, and viable businesses affected by the pandemic were able to access our intervention funds. While these measures will help to provide stability to our economy, the restoration of full economic activities will remain uncertain, especially till a cure or relevant treatment option is found to contain the spread of COVID-19. Indeed, the recent spike in cases across Europe has led to new restrictions being placed on non-essential movement. These actions may further complicate efforts to restore economic activities to pre-COVID-19 levels. It is therefore essential that as we work to sustain economic activities, we remain vigilant and continue to adhere to stipulated health guidelines on preventing further spread of the disease. In terms of stimulating growth and creating employment opportunities, I would like to note that COVID-19 has demonstrated that the impact that externally induced factors can have on the Nigerian economy. Supply chain disruptions and the concentration of production in particular countries have highlighted the difficult challenges that import-dependent economies could face in the event of a major pandemic. It is therefore imperative from an economic as well as a security perspective that we work to support sectors that have significant growth potential and that can create and sustain mass employment even in the face of a pandemic. A key area of focus to respond to this has been agriculture. And that is why we have sought to support or continue our support in this sector. The importance of this sector has been further reinforced by global supply chain disruptions. If earlier measures had not been taken to improve cultivation and process staple crops in Nigeria, we would have had to deal with a major food crisis in the country. In addition to using this sector as a bedrock of our recovery, Nigeria's agricultural sector also offers untapped opportunities for the nation to earn foreign exchange through the export of processed agricultural products. With declining foreign exchange earnings from crude oil, improved activities by export-oriented agro-processing companies would help strengthen and improve our country's foreign exchange reserves. Cultivation and processing of agricultural produce also offers significant opportunities for employment generation, which is vital given our growing population and should form one of the foundations of a robust post-COVID recovery. That is why over the next couple of years, the central bank will continue to work with commercial banks and other stakeholders in the financial sector to find innovative ways through which banks can increase loans to the agricultural sector from 4 to 10% by 2024. Another sector which has emerged as a significant source of resilience in mitigating the impact of COVID-19 on the economy is the information and communications subsector. In the second quarter of 2020, the ICT sector made contributions of over 15% to GDP growth, 20% higher than its contribution just a year earlier. It is important that we leverage ICT as an enabler for growth in key sectors of the economy. Technology startups are emerging to support SMEs and farmers, as well as provide quality learning to students affected by shutdowns in our schools. We must create an enabling environment to support the growth of this sector, which has the potential to not only serve the needs of the local market, but also is able to support export ICT-related services to countries across Africa and indeed to other parts of the world. Another area that is critical to stimulate growth is infrastructure financing. With the decline in government revenues as a result of the drop in crude oil prices, alternative ways of funding infrastructure has become critical if we are to generate the sustained economic growth we need for our shared prosperity. Nigeria will be unable to thrive in the post-COVID-19 economy without a backbone of strong infrastructure, power to supply factories, telecommunications to enhance digital connectivity, and transport infrastructure to support the movement of goods across the country. High quality infrastructure is therefore needed to act as a multiplier effect on growth and employment. Efforts are ongoing to ensure the effective establishment of InfraCorp, an infrastructure finance company that will be supported by the Central Bank of Nigeria, the African Finance Corporation, and the Nigerian Sovereign Investment Authority. This corporation will draw on sources of private and public capital to drive fresh infrastructure investment in the country. The entity would also enable us to raise funds from capital markets and mobilize long-term finance to address some of our infrastructure needs, while at the same time providing reasonable returns to investors. We believe that this well-structured arm's-length fund can act as a catalyst for growth in the medium to long term. In conclusion, ladies and gentlemen, let me add that while COVID-19 has brought on several challenges to economies in Africa and in Nigeria, we must not lose sight of the unique opportunity it offers us to build more resilient economies that are able to contain external shocks and to drive growth and wealth creation in key sectors of our economy. We must seize this opportunity to transform our economies and lay the foundation for more resilient, inclusive growth that will enable shared prosperity for all Nigerians. I thank you very much for your attention.
Thank you very much, the Governor of the Central Bank of Nigeria, Godwin Emefiele, being represented by Dr. Kingsley Obiora, Deputy Governor, Economic Policy Department, Central Bank of Nigeria. Listening to his speech, it got me thinking, and I know it would also get you thinking whilst you listened. The question that boils on my mind right now is, as Africans, are we ready to ensure that 2063 would be a turning point for achieving a more sustainable Africa and an inclusive future? Hold your thoughts there whilst